Welcome back to CEO Money. I'm Michael Yorba, your host. Thanks for joining us. All right, we've got Rich Callaghan, Managing Director in Portfolio Investments, Capital Securities Market. All right, Rich, welcome to the show.
Michael, thank you very much for having me on.
You're welcome. All right, you've got 20 years plus experience in this industry sector, and you manage well over 50 million of clients, funds in a number of directions and reasons. Let me back up, give yourself a chance to get some highlights on who you are. Then let's get into some of the questions that you deal with on a daily basis.
Well, Michael, thank you very much for this opportunity. I am a certified financial planner and MBA who manages both individuals and businesses' investments. I do so on a customized basis, making sure, and the most important criterion I think is making sure that we have identify and budget for a portfolio's risk, meaning how much volatility is in the portfolio, and taking that volatility and making sure it matches the investors, be it a business or individual investors' objectives, and more importantly, what they're comfortable with.
I get it. What are some of the important trends that you can forecast in the market coming up in 2018?
Well, Michael, I'd like to quote Mark Twain from History Doesn't Repeat, but it often rhymes. So I think that coming up in 2018, it'll be similar to 2017 in a lot of regards, where I think that the best return for investors will probably be still in the equity markets. And there's multiple reasons for that. One, the U.S. economy is really starting to pick up. We saw 2 consecutive quarters of 3% GDP growth. We've seen 4 consecutive quarters of rising revenue growth for S&P 500 companies. We're also looking at projections for S&P 500 aggregate earnings scheduled to be at $130 per share for 2017, $145 for 2018, and north of $165 in 2019. So that's a real good barometer of the strengthening of the U.S. economy and through increasing corporate earnings, which means that if earnings are going up and it's the E on a PE of stocks that we're looking at probably a rising stock market, and it wouldn't be difficult to project, in my opinion, a 10% increase from where in the S&P 500 for 2018. The other thing that happens is that the equity markets could also see if there's any type of meaningful corporate tax reform or individual tax reform or repatriation of offshore profits, then that money will be reflected in a sort of a boost in the stock market. Bonds, I think, stocks will also benefit, or corporate earnings will benefit from central banks being relatively benign towards a monetary policy, not being too aggressive in any type of tightening. The Fed, for instance, is scheduled to raise rates 3 times in 2018. I think the market's thinking it's more twice or 50 basis points in 2018. And the other thing is the rest of the world, for the first time since 2008-9, or that near-death financial experience, is also coming along with the economic recovery of the United States. So there's a real strong backdrop for continued economic growth, and especially the United States, where we could start seeing some meaningful 3+% GDP growth if with a little help from Washington, D.C.
What about the downside? We always have to think about that, especially a guy in your position. So what are some of the possible threats to the market, and how are you working with your clients to protect against those?
Well, thank you for asking that, Michael. Well, I think the threats are more political in nature or geopolitical in nature. Political, if there's something in Washington that goes terribly awry as far as the administration or tax reform. Geopolitical, our president is in that part of the world and just addressed the South Korean Congress about the threat from the north. Hopefully China, U.S. can work together and mitigate that. Also, the Middle East is always a hot spot for that type of geopolitical risk. With that being said, when I work with my clients, I tell them when we go into equities, we're basically going into the front door of a casino, but I want to know where the fire exit is. So typically, what I'll do is have some type of predetermined sell limits, good will cancel stop limits. That if the market does have a serious drop, then we're out of it. The other part is the fixed income, where my background, I have a strong background in fixed income, and I can pick and choose individual bonds that when, despite a rising interest rate, and your listeners probably know when interest rates go up, fixed income, the secondary market price of fixed income securities go down. What you want to try to do is find something that has definites, and definites in as far as when the interest is going to be paid, when the principal is going to be paid back, either through a call or a maturity. The other way you could possibly play that is going into financial preferreds, because if interest rates do go up, the economy is doing better, that sector and those preferreds should do well. The other part is another sort of a systemic, transactional risk in the form how investing is done these days, especially in equity investments. 90% of the trades on the New York Stock Exchange are done by an algorithm, and a lot of money is going into passive investing, meaning indices, the S&P, the spiders, and so if there's something that triggers those machines, instead of going to buy, which, by the way, the S&P 500 has just experienced its longest stretch without a 3% correction as of, I think, today. If those machines turn to sell, that whole homogeneous type of trading will take down the market.
Rich, we got to end on that note. I want to thanks for being a guest on the show.
Well, thank you very much. Always a pleasure, and looking forward to the next time.
My pleasure. Rich Callaghan, Managing Director, Portfolio Investments, CapitalSecurities.com. You've been listening to CEO Money with Michael Yorba, segment brought to you by Tycon Partners.